Hello and welcome to Semantic Reactions, the official podcast of the Institute of General Semantics. My name is Ben Hauk, and I'm pleased to be able to introduce the 32nd installment in our ongoing series. For our April 2025 installment, author, financier, and IGS Trustee Christopher Mayer returns to discuss the current economic situation in the United States with IGS President Lance Strate. Their dialogue emphasizes how general semantics can help us understand financial concepts such as the trade deficit, tariffs, inflation, and even money itself. Let's hear what they have to say.
Well, welcome to another episode of Semantic Reactions, the official podcast of the Institute of General Semantics. I'm here with my fellow IGS trustee, Chris Mayer. Chris has been interviewed in one of our early episodes, so welcome back, Chris. It's good to have you here.
Thank you for having me on. I think we're going to have an interesting conversation here to show people how Krzyzewski's general semantics can be very important in the world and what goes on. So I'm interested to see how this conversation unfolds.
As am I, because I don't have a clue, but I should say before we begin that Chris is the author of a couple of books on general semantics that are actually published by the IGS. That is How Do You Know? A Guide to Clear Thinking About Wall Street, Investing, and Life, and Dear Fellow Time Binder, Letters on General Semantics. So when it comes to talking about these matters, he's no slouch. You, of course, are involved in the area of money. What is it exactly that you do again?
Yeah, I have my own hedge fund. So it's I'm very much involved in the markets and what's going on. And this is my 7th year doing the hedge fund. And before that, I worked a little bit with the Bonner family office. The Bonner family is my partner now in the fund. And I published a newsletter for 15 years before that when they were my publisher. And that had a model portfolio. And I wrote about investing in markets and what was going on in the world and traveled all over the world from India to Mongolia to all kinds of places all over. And so I've been involved. And before that, I was in banking. So I've been involved in finance for 30 years now.
And Chris, I mean, I'm completely lost when it comes to these kinds of things. So when you say hedge fund, I think of like money you save in a coffee can for the gardener to take care of your bushes.
Yeah, I should say I think of it more like it's just an investing partnership like Warren Buffett had. I have 12 stocks in it. It's buy and hold style investing. I do all the research and I'm in contact with management teams and I understand the businesses very deeply that we own. And we look to own these businesses for a long time and hopefully compound that capital for many years. So it's actually very simple. I know that hedge fund covers a wide variety of financial vehicles and a lot of them are doing much more speculative things. But mine is it's very simple.
Well, and I should say that, while most people would think of general semantics, and associated, first of all, with science and sanity, that is scientific point of view, sanity and therapy, also language, epistemology in a philosophical sense, and communication. People, I think, wouldn't naturally connect it to economics and finance, although when you go back to Alfred Korzybski's first book, it's just kind of laid the groundwork for what would be general semantics. He does have a whole chapter in Manhood of Humanity about economics, looking at it from a time-binding point of view. And then the first popularizer of general semantics after Korzybski wrote Science and Sanity was Stuart Chase, who was, I believe, something of an economist, and he coined the phrase New Deal that Roosevelt picked up on. And wasn't there a book about Wall Street before you wrote about it?
Yeah, that was one of the things I noticed when I was researching this, that no one had written about general semantics, applying it specifically to investing in Wall Street. since John, I think it was John McGee in the 1950s, early 60s, and he wrote a book. It was called, the initial title was called General Semantics on Wall Street. And I always like that. I get a kick out of that because that edition quickly went and just changed the title to Winning on Wall Street. So I think he found out that General Semantics maybe wasn't the best-selling title at the time. So, but yeah, but since then there was this huge gap, and so yeah, I thought to try to bring it back, and that was what inspired me to write How Do You Know?
Well, I think, for those of us who know very little about these things, but do have retirement accounts, and are watching them kind of go, uh, you
Oh
know,
yeah,
all that is solid melts into the air, as I think Karl Marx put it. Um, what's going on? Are you?
yeah. Well, this is one of the interesting things, because we talk about general semantics all the time, and we come up with examples, and in the literature, there's all sorts of classic examples that sometimes, they illustrate the point, but they don't necessarily seem that important. So I'm thinking of like when Korzybski writes about a pencil and he uses that as an example of how you can't say, all about everything, or uh, there's these other examples, like the map example. The map's not the territory, and he talks about a map where I think it's San Francisco's in between Chicago and New York, and you think, okay, that seems very obvious, but it doesn't seem very important. And this is one of those times where I think that the language that we use is really having a tremendous impact on how people think about these problems. And so what I'm thinking about specifically is the trade deficit and tariffs, which have been dominating the news here for a while and have sent the markets in a great tailspin.
Yeah, what is
So,
going on there, Chris? Please.
yes.
It's it,
So,
it's
well,
scary and it's very confusing.
it is. It is. Well, I think maybe one way to start would be to think about that term trade deficit, what that means and what it is. And it sounds really bad, doesn't it? I mean, nobody
Hmm.
wants a deficit. It sounds like something has to be paid back. That's bad, and it's really not the case. I mean, this is, if we renamed it, I think if we called it, an investment surplus or something, nobody would have any problem with it. But think about what brings about a trade deficit. So if an American buys shoes from Vietnam for $100, that create and the Vietnamese on the other side don't buy anything from an American, then that creates $100 trade deficit. They have
Hmm.
$100, and
So they have
American
my
has the
hundred
shoes.
dollars, right? They took my money.
They have your money, and you have the shoes. So where's the imbalance there? What has to be paid back? Is there anything necessarily bad about that just on the face of it? It's
Hmm.
just a transaction. So the trade deficit, number one, makes all trade like that seem like a negative. And of course, there might be perfectly natural reasons why we don't want to make our own shoes, and we'd rather have the time and resources and human effort and capital doing other things than making shoes. And so we have the Vietnamese do it, and they are happy to do it. Uh, and so that's that. And so what happens is, we have in aggregate, Americans buy more abroad than uh, non-U.S. citizens buy from American producers. So, but what that means is they're holding on to this cash, and there's only so many things they can do with it. It comes back to us in different ways. They buy American services. They can invest it here. They can put it
Hmm.
in treasury account. They can do lots of things with it, but it's not necessarily by itself a bad thing. And I think that's the first thing to recognize about this trade. Let
So
me
so like a trade deficit isn't a lack of trade. It's not a
right,
deficit in the amount of trade that we're doing.
right. I mean, we do tremendous amounts of trade with all kinds of countries, of course. And the other thing, well, another way I was going to cast the deficit is sometimes I think about it. I mean, the way the administration thinks about it, because they put blanket tariffs on every country, so they kind of automatically assume they want to have something equal with every country, but that's not necessarily possible or desirable. I think I shared with you before. There was a kind of a funny tweet where someone said, oh, so we're going to punish Bangladesh because they're not buying enough Herman Miller chairs and, whatever things we make that are obviously very expensive for the typical Bangladeshi use. I think the annual income there is $900. So it's not realistic in that particular case. But you wouldn't manage that relationship that way. Just in your own personal life, think about it. I mean, if I were to think about it that way, I have a tremendous deficit with the grocery store down the street. For years and years, all they've been doing is selling me groceries. That's
Uh-huh.
they've been taking advantage of me all these years. I haven't, they haven't bought anything from me. But you don't think of it that way because you have other sources of income. You have other things that are going on. So that's one way I would help, frame that. So I think that just that language initially, that I really do think if it was something, if we didn't call it a trade deficit, I think people would think about it entirely differently.
So it's like a semantic reaction to the word deficit.
Yeah, I think so. And remember that, you could cast that deficit different ways. So, I mean, instead of saying, you could think about it as just in our simple example, uh, non-U.S. citizens have this cash. They have U.S. dollars in their bank account, and what do they do with it? They have to come back here some way. So, like I say, they invest it, or so you call it investment surplus. No one have any problem. We want people to invest in our country, right?
Hmm.
We want that. Um, so that I think that's very important, and I think one of the other things that comes out of this is people take anecdotal evidence and then they kind of extrapolate. So it's easy to sell the idea somehow that foreigners are taking advantage of us. But I don't know why, but people like to believe that story. But is that really
Uh-huh.
the case? I mean, you could easily flip it around and say we're the ones, taking advantage of them. These people in Vietnam and Bangladesh and China and other places aren't making a lot of money making this stuff for us.
Hmm.
And
So
while we
who's
do other
making all
things.
that money?
Yeah. So, I mean, that's the other thing. The other thing is we talk about this as countries. So we talk about how we have a trade deficit with a country, but it really gets complicated because it's not the countries, it's people, right? It's business people, it's companies trading amongst themselves, and we aggregate it and we'll say, China is taking advantage of us, or Vietnam is, we have a bad deficit with Vietnam, but this is just an organic thing that evolves over time. It doesn't automatically mean it's not automatically a signal for, unfair trade or something like that. Then people will say, for example, that the administration likes to sell the idea that the U.S. is not like we don't make enough. So that's the other implication of this trade
Right.
deficit. Somehow we're not manufacturing enough. They want to bring this manufacturing back here, and the facts don't really square with that very well. The U.S. is the second largest manufacturer of goods in the world, behind only China.
Wow.
The U.S. is like 15% of global output. The next closest country to us is Japan, which is half of that. And so the thing is that it's as a percent of our overall output, it continues to shrink. And of course, there are a little fewer jobs in manufacturing over time, and that's where the pain is. And there's obviously we have to figure out ways to help these people, reintegrate people who can no longer work in these factories here. I mean, there are other ways to do that, right? But we've made these transitions before. It wasn't that long ago where you could say the U.S. was mostly a nation of farmers, and we had all these jobs in agriculture that have since disappeared over time. And
Hmm.
I was just going to say we have this romanticized notion of like farming, but we've made that transition, and now we have this
Yeah.
romanticized idea of manufacturing. And I don't know that we can put that back in the bottle, but
But when
anyway.
you think of that, going back to farming, Ma and Pa Kent in Smallville on having a farm, what happened to farming that you know changed?
Well, I mean, part of it we know that it became very efficient and large scale, and so most of the farming done in this country now is large corporate farms where they employ very few people, and manufacturing is going that trend that way also. I mean, even the stuff we make, it's there's an awful lot that's automated and uses robotics,
Hmm.
and the stuff that's very labor intensive tends to go overseas. So if you look at like people who make iPhones, I mean these factories and I mean there are cities in China where maybe like 300,000 people are making iPhones, and could be in one city, which would be impossible to imagine here. I mean you got to see like Baltimore is like 500,000 people. So just imagine. I mean, I think Apple employs over 3 million people in China making iPhones. It's a mind-boggling number. It would not be possible, here. It's just so much time has passed, and it wouldn't be efficient. You wouldn't necessarily want that, and you know. So that's where I think Krzyzewski's general semantics helps you a lot here because it just forces you to ask some questions about these big abstractions like trade deficit and what is it? How does it come about? What does it mean? What does it
Mhm.
refer to? And you think through it. It doesn't necessarily have to be a bad thing, a catastrophe. So that's one big point on that.
Yeah.
And I think the markets don't like it either because then tariff, this is another word that comes out. What's a tariff?
Hmm.
And a
Yeah. Well, I mean, when
tariff.
Trump talks about the tariffs, and he's talking about it as a fee that is collected from the importer, from the foreigners, so to speak, that is what, that it's like we're taxing the other countries for their goods. Is that what a tariff is about?
Yeah, tariff is a tax on imports. So it is paid by the importer. And but what happens is the importer is not just going to just
But
take it. I mean,
who's the importer in this case?
yeah, so the importer pays that tariff. And who's the importer? Let's say it's a manufacturer of sneakers in China that makes sneakers for Nike and imports them here. So they have to pay the tax on the wholesale value of those shoes. Now, this is where it gets interesting because let's say what's their profit margin on this? Let's just say it's the wholesale value of the sneakers. Let's just say for ease of math, it's $10. And if they got to pay and let's say their profit margin is maybe, let's say it's 10%. So they're making $1 on every shoe. And then Trump comes up with a tariff and I mean, these are big numbers, these taxes. That's the other thing. I don't even know what it's at now, 100%,
Uh,
50%. I mean, it's such a big
what
number. But
day
let's
is
just
it,
say,
right? Yeah.
yeah, let's just say it's 25%. So it's $2.50, that they pay for every $10 wholesale value of shoes. They're not making enough money to cover that. So they have to do one of two things. They could either raise the price of the sneakers. Suddenly that's okay, Nike, but we can't, import these for 10 and gonna have to charge 12, or, maybe they eat some of it. Maybe they try to pass on more, or maybe they try to eat none of it. Maybe they try to pass the whole thing on, or maybe they decide they can't. Nike says no, we can't pay that, and then you can't get shoes at all because it's not economic to export them to the U.S. So there's all kinds of things, calculations that will have to be made, and I suspect that, I mean, the administrations walk back their tariffs and they have a 90-day whatever freeze on it. But if you have very high tariffs on a lot of goods, I think Americans suddenly will find that there are just certain things you won't be able to get, or they'll be very expensive. You
Hmm.
know, uh, and to be truthful, I mean that's the way it is in a lot of other countries. This is the way other countries live. I think people exist. You can't just get everything. Some things you
Hmm.
just can't get, and so
Yeah.
Americans are going to have to, if this is the way it's going to be, we're going to get used to the fact that you can't get everything. It's not going to be so easy. Um, so it's a different world that way.
But if we still get them, they'll be at a higher price, is what you're saying.
Yes.
And
Yes.
yeah, I'm still confused though. So the tariff is paid by the source or the receiver, by the other country or by the company here that's purchasing the
Well,
imported.
it's paid by the importer, so it would be whoever's trying to bring goods into this country would pay it.
I see.
But then, like I was saying, it's not like everything just doesn't stay still. They're not just gonna just pay it. They're gonna
Hmm.
look at it and they're gonna go, well, this takes a big chunk out of my profit margins, and they have to decide, well, is it still worth it for them to import it in at that price and just make less money? But
Right.
again, because the tariff rate's so high, we're not talking about 2% or 3%. He's talking about 25%. I mean, that's even higher. I think it's 100% on China. Things coming from
Yeah.
China specifically
Or more. Yeah.
or more. So, I mean, and then, there were little hissy fits where he put 200% at one point on champagne, So, talking about big numbers, which then those importers have to make the decision. Well, you know, is it worth it? Uh, it may not be. Certainly, I've seen research that says, the average price of a car could go up anywhere between $5,000 to $10,000,
That's
just
a
as an
lot.
example. It's a lot of money. And then what are the domestic producers going to do? Are they going to say, well, we'll just keep our prices low and we'll be a low cost guy, we'll take all their business? Or are they going to say, well, there's now a $5,000 difference between our cars and theirs. Maybe we raise our prices $2,000. We're still a lot cheaper, but we can make more money that way.
Hmm.
So that kind of thing will happen. And then the other thing is, we're in such a global integrated economy, it's hard to sometimes separate who makes what where. So if you look at
Yeah.
the top, domestic producer of cars, for example, of course, Tesla and Rivian are on the top. They make every car they sell here, they make here. But I think Ford is the next highest at something like 70 some percent of the cars they sell here, they make here. But the number fourth I remember was Honda. It was like 68% of the cars they sell here, they make here. So then it
Hmm.
gets very confusing. Like well,
Yeah.
like there's Chevys that are assembled in Canada. And so just because it seems to have a label on it that you associate as an American company, again, language, how American is it really? Toyota
Yeah.
is a Japanese company, most people would say, but it has a plant here, employs Americans here, builds cars here. So it gets very complicated to sort that
Yeah.
out.
Yeah. I think I saw that about U.S. Steel being purchased by a Japanese company, and that the workers are in favor of that because that'll keep them employed.
Yeah. 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 So, I mean, these are the kind of things that people will be thinking about. And of course, it's dramatic. The markets didn't like it at all because you have tremendous amounts of trade that goes back and forth between all these countries, and now good chunks of that seem to be at risk. So anyway,
Hmm.
yeah, again and again, I think comes back to a lot of this is just language and the way people label and think about things. Um, where a
Yeah.
good dose of Krzyzewski's general semantics can help clear the air a little bit. At least you don't even have to be an economist. At least it gets you asking the questions, gets you down that road.
Which is important. And I mean, just the the term economy itself, um, it is a very high level abstraction. I can't help but think of the South Park episode where, and I think it was after the recession in 2008, and they had all these folks and talking like prophets, trying to explain what the economy wants as if they were like kind of, New Testament era prophets, biblical prophets getting up there and saying, the economy doth declare, that the economy wants this, and uh, and it sort of is like a trying to read the tea leaves or interpret the signs, and are dealing with something so totally abstract that no one really knows, and what the economy is about or is doing, and especially economists themselves who all have their theories, but do they really match what's going on?
Hmm. Yeah, I love that. And I've written about that before, about how the economy is not, it's a giant abstraction. So what is it? And we talk about it as if like it's an animal in the backyard, or we can measure its health and we can see how well it's doing. And people talk about what's good for the economy and what's bad for the economy, but it's not so easy. I mean, what is it? It's just a big way, just a word that sort of covers this whole world of people buying and selling, and but that's it. So when you say something is good for the economy, it's almost never really true because it's good for some people in that economy and not so good for other people in the economy. Even when we were talking about this tariffs and the trade wars and stuff, is it bad for everyone? Of course not. Right? There's going to be some people that are going to benefit greatly from this, and others not so much. So yeah, I mean,
Yeah.
I have a paper out that's coming out soon called "Modern Totems of Our Imagination," and like one of them is the economy, which I talk about, uh, and other things that tie into this, like inflation. You surely
Yeah.
hear about that. Uh, when people talk about inflation, government talks about inflation, managing inflation, what are they talking about?
Hmm.
And
Yeah.
what they're really talking about, they're talking about something called the Consumer Price Index, which measures that. But that again is a very difficult thing. So that, I always chuckle when the news it report, the will report inflation was up 2.8%, last month. Seems like
Yeah.
it's so precise, like it's just something we just go measure.
Hmm.
But it's a giant abstraction built on a lot of assumptions. And, think about how you would even begin to measure inflation. And even if you compare like with like over time, it gets very difficult. There are certain things that you can buy now that weren't even available 20 years ago.
Hmm.
And yet people, when they put these charts out, they'll show CPI and there'll be a chart that goes all the way back 30, 40 years. But even a car today is not equivalent to a car 20 years ago or 40 years ago. We have iPhones that weren't available. They had fax machines then; they're gone. So,
Uh-huh.
and even something very simple like you say gasoline. Okay, gasoline. Well, everybody knows that gasoline. There's not one price for gasoline. I can go to different gas stations if I'm in town or if I go way out and can
Hmm.
pay a lot different for gas. So, which do you use? Or even, there's a line in the CPI for new vehicles. Well, there's a lot of new vehicles, a lot of price points, a lot of differences in what, the
Hmm.
extras are. So which one do we use when we're calculating the CPI? Of course, economists over years, they have workarounds for all this, but the point is it's built on all kinds of great assumptions. And then over time, those assumptions, because the way those calculations go over time, they can become very wide. So you can look at the way CPI was calculated 20 years ago. And if you did it today, you get a very different number than the number they report today, just because we've made a lot of changes to it because different products are available now and all these things we've talked about. So it's a very hard thing to manage.
Yeah.
And yes, and that creates a lot of problems too. When
I think that was part of the problem that with Biden and his administration was, looking at the economy in this very abstract way based on statistics. Even, when you're saying that inflation is going down, but what they mean is that the rate of inflation is lessened, which still means that that things are becoming more inflated, I guess, but just less rapidly or than they were before. But it was just that overall insistence that the economy is very strong based on statistics rather than the kind of concrete lived reality that people were experiencing, that they weren't paying attention to, seemingly.
absolutely, and that's why we're in a weird situation where the U.S. economy had been doing quite well, looked at it from that view, that 50,000 foot view of statistics, but a lot of people were unhappy with it. I mean, we see these rise of deaths of despair. And I mean, we can go on. There's lots of evidence that a great number of people were not necessarily doing so great.
Hmm.
Um, and they feel the pinch of the inflation numbers more so than, the people on the lower part of the economic pyramid feel those pinches more than people on than the upper part of the pyramid, of course. But because, when the price of groceries goes up, they're spending a lot bigger percentage of their income on groceries than people on the higher part of the economic pyramid are. So you do have this disparity, and it grows out of that. Too much attention to statistics, not enough attention to the lived reality of how a typical person finds the economy to be.
Yeah.
Finds, not even say the economy, just finds the daily existence of buying things, and trying to make it work, with their
Yeah.
income.
I forgot who it was that said, in contrast to unemployment statistics, that when a person is unemployed, that's 100% unemployed, which is, this idea of bringing it back down. It kind of reminds me in another frame of Stalin's famous quote that one death is a tragedy, a million is a statistic. That how these numbers kind of pull us away from what people are actually experiencing.
Hmm. Yeah, and there are all kinds of different ways even to calculate that unemployment number. So you could have somebody employed, they're working, but they're not necessarily, there's that kind of the idea of underemployment where you have people, okay, you had a lot of people that were out of work and they've suddenly taken jobs that are well below what they can do because they, have to live or whatever. But so unemployment looks better, but is it really that good for the people involved? The other thing that irritates me, the way the Fed thinks about unemployment is they still have this mindset where if inflation goes up too much, then they really will almost work to create more unemployment. There's this theory that
Hmm.
creates some slack in the economy and will bring down inflation, and that really drives me crazy. It's like how much, you know, you're you're creating human suffering
Hmm.
for this abstraction of this inflation number that you've made up, and it's now your North Star, and that always baffles me. That
Yeah.
idea.
Yeah, that always seemed kind of disturbing. Um, which I mean, there's another aspect of the economy. Is uh, the I mean, who is it that manages or declares interest rates?
Yeah, Jerome Powell, the Federal Reserve.
So the Federal Reserve. I mean, what what is that about?
Yeah, well, the Federal Reserve manages a very short-term interest rate. Um, and then that has an influence through the rest of the curve. So they really don't have
But
control
is
over,
that
say,
interest on what?
on well, the rate they control is the rate that banks lend to each other, called discount rate.
Mhm.
And a lot
So
of the
this is
rates,
not like this is not what they charge me for my credit card, for example.
no, but a lot of the rates in the economy will key off that.
You
And
know,
then,
and then in my bank accounts, I get like pennies, if that. Checking accounts used to give you interest. Now they mostly they don't, or the fees they charge actually are more than the interest you get, but still you get taxed on the interest and
yes.
don't deduct the fees. I mean, what's going on there?
Yeah, I mean, the Fed does not have control over the long-term money. So like 10 years or mortgage rates, those are market rates, but the Fed can influence them by what they do with the shorter term rate. Um, and their control over that is much less than I think people tend to think. Like they think maybe the Fed is somehow managing interest rates, but interest rates are kind of complicated. I mean, it's what causes interest rates. It's just really the price of money in a way. And for someone to part with their money today and give it to you for 5 years, the interest rate is the price. What is it? What's going to cost you for that money? And we have treasury securities. So the government has treasury securities that are out there, and that's kind of the benchmark rate. So let's say the 10-year treasury rate now is somewhere around 4.5% or somewhere around there. And so everything would key off that. So if the U.S. government treasury security is seen as being risk-free and that there's no chance, this is a perception, that you're not going to get paid. The government can always pay you back. Government creates dollars and all of its debts are in dollars. It can always pay you. Those dollars might not be worth as much as they were when you first gave the money, but they can always pay it. So it's seen as a kind of a risk-free rate as far as credit goes. And so everything else builds off that. So now if a bank is going to give you a mortgage for or give you some kind of loan for 10 years, it's not going to go less than the 10-year treasury because you're a riskier bet than the US government. So it's going to be some margin over that. And usually it's something like maybe 200 basis points over that. So if it's 4.5% in the treasuries, it'll be 6.5% for mortgages, something like that.
Mhm.
Um, so that's how it works. And the market's just constantly making those adjustments, and
And
it's
and
real.
so is the Federal Reserve the ones who do issue these treasury bills that you're
The
talking
government issues these treasury securities, and then there's a bid process in the market, and every month there's constantly treasury securities being sold, and they're being quoted every day in the market, just like stock prices. There's treasury
about?
securities, and that rate, the market reads all kinds of things into it. So when if rates are going up, so that could be because The bond market's afraid of inflation, so they're thinking prices are going up, so they want more now for their money, tie up their money for 10 years, let's say. If treasury rates go down, they're going down like 1%, then that might be the bond markets are saying, you know what, and we see bad things happening. The economy is going to contract, inflation is not going to be a problem, so we're willing to lend our money for less because we want that safety. So it's just a big
Yeah.
auction market.
So you're mentioning the bond market, that's the market for these treasury bills.
Hmm.
And I thought I heard something that when Trump backed off the tariffs
Yes.
initially, that was not because the stock market was crashing, but because the bond market was declining. Is that, can you explain that?
Yeah, I mean, I read that story as well. Of course, I don't know what really, what really made him back off or not, but that was one idea was that when rates started to go way up, that kind of spooked him. And of course, with rates going up, he doesn't want that because that affects everything. It makes, government interest costs go up, mortgages go up. So that he doesn't want that. And that was the thinking that the bond market started to fall apart. Rates started to go up. He saw that and he backed off it
Why did rates go up?
because people are fearful and thinking that prices with these tariffs, their thinking is that prices will go up. So inflation was going to go up, and when inflation goes up, it's another way of thinking. Well, your money is losing value.
Hmm.
Higher rates of inflation, your money in your pocket just starts to lose value. So if you're a bondholder, and remember, bondholders are tying up their money for 5, 10 years at a time and getting a fixed rate. Well, now you're going to want a higher rate than you did before because you foresee that these tariffs and prices are going to go up are going to make your money not be as worth as much. So you're going to require a little more now to part with that money for 10 years. So that's why
Okay,
rates started to go up.
I see.
And then when it eased off, then the market started to back off a little. Okay, it's not going to do that. So it
And
becomes a big game.
this may sound like a silly question, but why does the government want to sell treasury bonds in the first place? Like, what's the reason that we do that?
Oh, this is very controversial. Um, because people will say that the government does that because they have to borrow the money, but that's not really the case. The government never doesn't really have to borrow money. And again,
Hmm.
the government creates money. It's the one that creates
Right.
dollars. It never has to borrow them. And if you think about it just logically, I mean, how can anyone buy a treasury security? You have to have the dollars first to buy them. And where do they get the dollars? The dollars have to be created somehow, spent into existence. So it's not really a financing mechanism. I mean, the truth is they don't have to. They don't have to issue treasury securities.
Hmm.
And I know if I say that, I know there's a lot of people who are going to say I'm crazy. I don't know what I'm talking about, but I'm telling you, it's controversial.
Uh-huh. Well, isn't it that aren't they saying that China owns a lot of these treasury
Yeah,
bonds?
well, naturally, right? If a country's run the way our trade is run, I don't hate to use the word trade deficit, but that's the word we're using.
Hmm.
That naturally means then there are a lot of dollars being held by people who've sold us a lot of stuff. And so what do they do with it? Rather than just have it sit in their bank account, they think, well, I want to get a little interest for it, so they buy treasury securities. Now they can earn some interest.
Hmm.
So yeah, China and those countries own a lot. But it doesn't mean that they have any sort of control over the US. I mean, there's this perception somehow that they like they have some kind of weapon that they can dump all their treasury securities and the bond market will be in chaos. I mean, they could do that, I suppose, but it would hurt them because they have all these holdings that are going to then lose value as they dump them.
Hmm.
And if the U.S. government wanted to, the government could just take them all back. There could be very little disruption in the market. Again, because the government creates the dollars. So the Fed could just step in and take all those treasury securities, no problem. Whether they'll actually do that or not, I don't know, because a lot of people, again, they get lost in kind of the abstractions of it and forget that the government creates money. So it's all these cases where the government's going broke. We hear this. It can't be true. It, it government can always pay all of its bills. It may choose not to for a variety of reasons because Congress doesn't want to allocate the money or for whatever reason. But in theory, it can, it has the ability to create money. That's an important thing to remember.
So this sort of takes the wind out of the sails of the so-called deficit hawks in
Yeah.
Congress.
Yes. I mean, we've run a deficit for most of the 2+ centuries we've been around. So uh, it's not a problem that way. It can be a problem in other ways. Obviously, there's only so many, resources around. There's only so much like stuff around and people around. That's your limiting factor, not
Mhm.
necessarily the money. And this gets to what, the way Krasipsky thought about it as well. When he, thought about money, and he writes about this in Manhood of Humanity. He relates it more to like a measurement, like inches. Um, so money, and then he thinks about money and wealth as being kind of the product of I think, he says the product of time and toil. So it's like
Yeah.
all the wealth we have that came from people long dead. And then, the other word or phrase I remember he uses that I like, he calls it a free gift of the past.
Mm.
We have all this stuff that
Yeah.
people have accumulated knowledge that we have. That's the real wealth that we have. It's not necessarily the dollars. We know the dollars have lose value over time. We all know, like when we were kids, how much it cost to buy certain things, and it costs a lot more now. You can get like haircut or chewing gum, whatever it is. So it
Right.
happens. But we can't lose sight of the real, what do we want to say? The reality. I don't know if that's a good word behind the money, which is the people and the stuff and the
The,
know-how,
the
the wealth, as
territory.
Krasipsky would have. Yeah.
Yeah. Well, yeah, I mean, one thing that does strike me as really misleading is when they talk about, say a family balancing their checkbook and how you can't, owe more than you have, which, of course, flies in the face of people with credit cards, which, I mean, ultimately gets people into trouble, but I mean, you certainly can do that. But that, to sort of use the metaphor of family finance as a appropriate map for the territory of a whole nation strikes me as being done in very bad faith.
I would absolutely agree with you. Absolutely agree with you. The U.S. government has very different constraints than a family household budget. And yeah, so the two are not equivalent at all. There's no analogy that works there at all. So
Yeah.
I agree.
And when you talk about, issuing money, and this is something I mean, my colleague Paul Levinson brought this up, and I certainly feel the same way. We have this sentimental attachment to coins and currency that seems totally irrational. And it's hard to believe that we were once a very progressive nation in using a sort of decimal system for our currency. But here we refuse to get rid of the penny, and that Trump actually, and that's one of the few, in my view, few sane and appropriate brought up is we ought
Yep.
to. I mean, we ought to eliminate pennies, nickels, dimes, maybe even quarters, but certainly anything below a quarter doesn't seem to make sense anymore. Um,
Yeah, certainly agree with
and
that. I mean,
and
again,
dollar
it's a
bills rather than using coins for that amount, I mean, also doesn't make sense anymore.
I totally agree. I mean, they're just tokens, and again, people are confusing the map with the territory, or they're confusing the abstraction with what we're really trying to, measure in some way. It shouldn't matter really. If the quarter could be anything, it could be whatever we decide it to be. It doesn't. It could
Yeah.
be, pink, circles with, whatever. It doesn't matter. Uh, it's it's this idea of like inches. Like, you wouldn't necessarily care, 6 inches measured by a piece of wood versus 6 inches measured by metal doesn't matter. It's 6 inches. So,
Or what's heavier, a pound of feathers or a pound of lead?
yeah, there you go. Yes. And, again, I mean, all the stuff we're talking about, I think, like, having some knowledge of Krzyzewski's work in general semantics is a tremendous tool to help peel back these things. I think it's much harder for people when they don't have that sort of training. We naturally sort of think about it that way, we just sort of naturally think about dollars. Okay, the paper, the coin is not necessarily the thing, but it's more difficult for other people to make that jump.
Yeah. I remember, and it's sort of like a misplaced concreteness, and which is mistaking the map for the territory. But I remember Neil Postman in class, once saying that, people like him and me who don't understand money as opposed to people like you. It's, you say, you go to the bank and you deposit $5, and then you think, you can go to the bank and say, show me my $5. I want to see my $5. Like that, it is a thing that you have, and that they're sort of watching for you. So what is it then?
Yeah, I mean, when you put $5 in a bank, it's just a completely, we say it's a fungible asset, and that it doesn't, the actual $5 doesn't matter. It's a computer. It's just a number entered on electronically in a computer screen somewhere, and that's what it is. So, I mean, maybe don't know enough about the anthropology of money to say that maybe perhaps some point long ago, there was actually kind of safekeeping that was that way, like you describe it. You
Mhm.
would, deposit your coins, and they would actually be your coins, and they would stay there, and you would go back and get them. But we've long moved on to what we call now is entirely a credit-based economy, where where all of our wealth is denominated in electronic figures and database somewhere. So it's
Yeah.
a little weird.
I think, the kind of earlier sense that you're talking about is sort of like the palace treasury or the dragon's lair with the hoard of gold that it's guarding.
Yeah,
Yeah, but
Dragon's Lair.
Marshall McLuhan talks about money as a medium of exchange, and that there is this transition that we've experienced when that we had coins that were worth their weight, and that all of it's sort of interesting when you look at it that many of the terms for currency are terms that mean weight, like peso. Um, and it means, I think it means pound, and the British pound literally means pound, and the symbol for it is the L for Libra for scales, and
Right.
that they're all come from this idea that, a coin is worth its weight in gold or silver, and then that paper money replaces it and becomes something unreal to people, and so you get the folks who are, fill their mattresses with bills, and as opposed to the banks.
Yes. Well, I mean, if you, I know David Graeber wrote a great book called Debt a long time ago, not that long ago. I think it was 2013, something like that.
uh
And it's about this anthropology of money. And he makes the case that actually the credit came first, that people would do things for each other based on just a promise. It was just a credit.
oh,
And then later the money came into it as a marker. Whatever that is. It's interesting to think about. But yeah, I mean, in some ways, I know coins even very early on were not necessarily worth their weight in gold. Because they would stamp them with a number as well, and that number trumped whatever the weight of the actual coin was. And people have been clipping coins for a long time, and it didn't take long for people to figure out they could make a coin and stamp it in a certain way and have it be worth something without necessarily the melt value being what dominated. Melt value would be like if things started to really break down, and the political entity that issued those coins is no longer anymore, then you melt the coins because it's not It's not,
Yeah.
worth much. But those are certain specific circumstances.
Yeah. I mean, it does come down to what we think of as real. I can't help but recall how my mother, I mean, we all, I mean, those of us of a certain age remember when there were bank books. Um, and the IBM Selectric made everything look official. The tellers would actually type on the typewriter. But for my mother, the bank book was real. And when banks stopped issuing bank books and went to just these plainer kind of statements, paper statements,
Mm.
she found that very upsetting, and actually found a savings bank that still used bank books and was much comforted by that. And I can remember feeling a little uncomfortable about the shift from paper to electronics too. There's this feeling that it could all just vanish. And of course, there are lots of certainly film and TV narratives where some hacker or some entity is able to do that to people, that you can just make your savings, your fortune just vanish, through some kind of electronic mumbo jumbo.
Yeah, and that comes in case in even in my business, people, we talk about stocks. What does it mean? If you own a stock, you actually own a percentage of that business. So it's the way I think about it is, you're an owner of that business. There are only so many shares out there, and those shareholders own that business. And but I think that's really lost in a lot of people because the way they just trade stocks every day in and out, and that tie to what it really represents can get lost. But that's again an old-fashioned view. Thinking of stocks as shares of a business actually changes the way you think about them too. You own them for longer periods of time. You own them like you would own real estate or something like that. And then that way they seem a little more real to you too. They're not so abstract.
Well,
You
it's
can be,
interesting you bring that up because I think it was um, 80s or 90s, and Peter Drucker, who was sort of the founder of management studies and business schools, basically, and he wrote that, that sort of like the age of capitalism was coming to an end because workers were all having retirement accounts, which invested in stocks. So more and more companies were being owned not by, select few, rich capitalists, but more and more by, democratically by people, um, in general, people, working people. That proved to not be the case. And as I understand it, it involved a change to the nature of stocks, that the stocks being issued are no longer voting shares.
well, there are some like that. This, this is something I look at when before I invest is companies. There are companies that issue what's called dual class stock. So there'll be voting shares. Particularly, this is prevalent in Silicon Valley. So you'll have A and B, and you'll have the A shares get super majority votes. So it's that way the insiders can kind of keep a much smaller percentage of the shares. They can sell a lot of
Mhm.
shares, but they still retain control. And I don't like that. I think it's bad governance practice, but you do see it.
Yeah.
Um,
But this has
mhm.
prevented that kind of democratization of the stock market and of businesses that that you still have these small, relatively small group of people who
Yes.
control and profit from these corporations.
I think a lot of it too would be if it's maybe a little bit pie in the sky, but if we gave people financial education very early and let them and kind of taught investing at a very early age, like the value of putting aside some money and putting it in the stock market, owning businesses for a very long period of time. Like I know both my kids have brokerage accounts, and I had them open them up very early, even just to and just to buy something so they could get a feeling for it. Like my daughter bought Spotify because she likes Spotify, and my son bought Domino's Pizza because he likes Domino's Pizza. And of course, then I had the S&P index for most of it, but just so they get a sense for, you put the money
Yeah.
in, they could see it kind of go up, and they were always amazed, it would go up and they didn't really do anything. It's worth $150 more than it was last year.
Oh,
But to have it that early, when you're in your, let's say, late teens, early 20s, even to start with just a little bit, that's a lot of future compounding. I mean, in 20 years, it could be a significant amount of money and they'll still be pretty young.
mhm.
So it's
Yeah.
it doesn't have to be that way. I mean, I don't know, there'll always be that way where you always have, people at the top who seem to own a lot of most of everything. But there are ways for people to participate, even with very little amounts of money, but they have to know about it and they have to stick with it. Because this is a long-term thing. Like I say, you have
Yeah.
to stick with it for 20 years, putting aside a little bits amount of money, and then it can be a significant sum. But
Yeah. Well, I do remember having being asked to open a savings account in elementary school and having that much. But I
and
think
of
you're
course,
right.
back then you got real interest rates, so you could look at it. Wow, you got $6 more than you.
Yeah. Yeah, yeah, that was fun. But I think what you're proposing would be really great. Yeah, I just wanted to note, I mean, what Peter Drucker called was, he said it was post-capitalism um, that was happening, and unfortunately, and really tragically, that's not what came to pass because presumably having been advised or having realized what was happening, the corporations acted in a way, changed the stock issuing that to prevent that kind of democratization.
Mhm. Yeah.
But yeah, um, I was going back to the stock market when we were talking about that, and and obviously, this is a concern for you investing and all of that. And you kind of brought this up earlier that, there's a sense in which there are always winners and losers. No matter what's happening, some people benefit from it, some people profit from it, while others lose from it. And with what's going on in the past month or so, and and I mean, we're certainly all agonizing. If you have a 401k or another retirement account, you're seeing that value plummet. I mean, who's benefiting? Who are the winners in what's been happening?
Yeah, I mean, that's a great question. And I don't really know yet because it's hard to think through. It's very complicated. Even just in looking at one company, what tariffs do, it's not so easy to figure out because they get materials from a lot of different places. And it's not like everything stays still. You know that phrase economists like to say, ceteris paribus. They'll say, change, if this changes, ceteris paribus, if everything else stays the same. But everything else never stays the same. So you change one thing and thousands of other things change. So it's very hard to figure out. But I mean,
Basic
just as
ecological principle, yeah.
basic ecological principle, right? You can't just like take the wolves out and everything stays the same, right? Or whatever your choice is. So,
Wolves of Wall Street in this case, yeah.
yeah, exactly, exactly. So, like, if you think about it, I mean, I'm going to speak generally because I don't know specifically. I did mention, Tesla and Rivian as being two companies that they sell every car or vehicle they make here, they sell here, they make here. So you would think that they would have an advantage against competitors who have to import. But again, that may not be 100% right because I'm not sure. Just because they say their cars are made here, it may be that a third of the parts or something come from somewhere else, and then those things are imported, so they may get impacted. But
Mhm.
in general, a domestic producer, 100% domestic producer that has a lot of foreign competition would be a beneficiary, at least you think on the surface. But again, it can get complicated because if the economy goes into the tank because of it, and, they may yet be worse off. They might be better off, vis-a-vis their competition, but they might be better. They might have been better off the way they were before. So it's hard
Yeah.
to say. And also, we don't know what the official rules are. They change all the time. I mean, almost not every day. It might be an exaggeration, although sometimes it feels like every day. But the most recent rules they put in, then they had all that pushback, and then it's okay. It's a 90-day pause. Well, that's what's going to happen now. It's just yeah.
Yeah.
So it's very hard to say.
Well, but as far as the stock market's concerned, are there people, who might be gaining from what's been happening, who might be profiting?
I mean, maybe, but I mean, I would say overwhelmingly it's been bad for the U.S. stock market.
Yeah.
I mean, most stocks are down. A lot of the big tech names are down. Obviously, something like Apple, where they're making all their iPhones overseas. You know, so in my case, my portfolio, it's a pretty global portfolio. I have 12 stocks, but a number of them, I got a business in the UK. I've got one in the Netherlands. I got one in Sweden. In Poland, and I have a few in the US, a few in Canada. So it's kind of spread out. And so my fund has done okay. It's still up for the year somehow, but there's a lot of things to take into account because it's not only then the tariffs, it's then what the currencies do. So the US dollar has come down, relative to other currencies. So I'm just saying it's too complicated to sort out now. I think it will be more apparent later. Like if you ask me this question a year from now, I'll probably have a better answer because it will be more
Yeah.
apparent as to who's winning, who won, and who's winning, who won, and who's got an advantage and who doesn't. But right now, it's so hard to tell.
Well, isn't it? I mean, there have been some accusations that there are at least some folks who would know what's coming, like know what Trump is going
Oh,
to tweet out, the following day, and are, with that advanced knowledge, will know to buy or sell, in the short.
yes. Yes. I mean, that was the thing where Trump put out his, good time to buy 4 hours before he reversed the tariff. So, if you had knowledge of that, you could have made a lot of money very quickly. You could have bought S&P call options that were close to expiration, and you could have made 10x your money easily, probably more than that. So that's something being looked into. And I think that I saw earlier a tweet, somebody had put that out, that the call volume for the S&P, like, you know, hour before he actually rolled it back, was like huge spike in volume. So it was all this trading. Like somebody
Mhm.
knew something,
Yeah.
you know. And that will probably come out with the fullness of time. We'll know who did what, maybe. But definitely would be a huge advantage to know.
Yeah. Well, it certainly seems like general semantics can help us to better understand what's going on. Um, Maybe not necessarily, though, know what to do, especially if you have a territory in which the map is very incomplete and territory is very dynamic. Um, and sometimes we have maps that are really way off. I'm thinking about the folks like someone when you have someone like Bernie Madoff, um, who's issuing statements about all the money that all the investment profit that he's producing that had nothing to do with what actually was happening, where he was just doing a kind of Ponzi scheme. Um, how do we guard ourselves against that? I mean, for us, again, for folks like me who don't know the first thing about what we're doing, and we
Yeah.
can't go back to being children and learning about this, but what would you recommend to folks as far as how to just how to steer through this current climate?
Yeah, I mean, I think number one thing is to keep your eye on the horizon, long term. So I would only put money in the stock market that you're pretty confident you're not going to need in the next decade. And then the odds are very good in your favor, at least historically. I mean, you have to remember the stock market. There's been a lot of bad things that happened in the 20th century, for example, and yet if you just left your money in the S&P for a couple of decades, you made a lot of money. So, and that's true into the 21st century. We've had a number of problems. There's always something. I mean, 2022, the market went down because we were worried about Fed raising interest rates, and we had COVID in 2020. We had all kinds of events before that. COVID, well, what, market fell something like 30% in March alone, something like that. It was very fast and severe. But if you take the long view and you'll be and you're diversified, owning something like the S&P 500 or some broad index, and you own it with the idea that you're going to own it for a long period of time, then you don't have to worry so much about these things. Because nobody's going to be able to figure it out, and over a 10-year period of time, it's just a question of like what kind of your return is going to be. It's going to, maybe historically the long-term return in the market's around 10%, but maybe it's less than that. You don't know. But if you take that long view, then you don't have to worry so much about trying to figure out what every headline is going to be or what next year is going to do or the year after. And you just put a little money in, every year if you can, and hold on, be patient.
Yeah.
That's really the best advice.
Yeah. I can't help but think about there was this wonderful TED talk, right, really a few months before he passed away, from Benoit Mandelbrot.
So
Um,
yes,
on, who's the kind of the key
fractal.
fractal geometry fellow, and he had written about the stock market as well. And he said, again, I don't really understand it very well, but he pointed out that economists tend to leave out the big anomalies, the big leaps, which are often like the big dips, like we're experiencing, but that they are in fact part of the overall picture and should never be left out.
Yeah, I mean, even since the 2009 crisis, I mean, the market got cut in half then, and it's been on a pretty decent run since. But even then, it's had something like at least 10 occasions where it's dropped more than 10%. And I think there's been 4 times now where it's dropped more than 20. So those are features, yeah, not bugs. They're part and parcel of the market. You have these pockets where that can have a great impact in a short amount of time. And this trade war thing kind of feels a little bit like a big event, like a COVID, which changed things afterwards, or 9/11. And I
Hmm.
mean, we were just talking about the economics of it, but there's the political ramifications too. What does it mean now? These traditional alliances that have held since World War II are frayed, and what does all that mean? What does it mean going forward? And so
Yeah.
who knows? But as far as the stock market goes, yeah, these big events are part of the journey, and they're normal actually for you to have these big dips. So we just had one peak to trough. The market was down 21% in a very short amount of time, and I'm sure there'll be more. But overall, I'm betting that the return will be decent.
And of course that's fine if you're of a younger age. I'm of the age where many of the my colleagues and people I know are retiring. And when you retire, you tend to your retirement account sort of gets fixed on whatever its value is at that moment. So would the advice then be that this is not a good time to retire and to just hold on
Yeah, I mean
a few more
that's
years?
very unsettling, right? If you're for the people who are about to retire and they had this nest egg in their stock market account and then it's worth 20% less, that's more difficult. And I mean, nobody knows. I'd love to be able to say for sure it will come back and it'll be at highs next year, but I don't know for sure. Who knows? The odds are good. The longer you hold it, the better you do. But if you have a retirement clock, then you can't, the way I think about it is that minimum 10 years. So if you can't leave it in for 10, then you have to start thinking about lightening that exposure somehow.
Hmm.
Whether it's a mix of having some in bonds but most people, I mean, if you're close to retiring, you're going to have some portion probably still in stocks.
Yeah.
So these are kind of personal questions, depend a little bit about your appetite for risk and how much you have and how much you think you're going to spend. And but there are ways to navigate those things too.
Well, this is all very good advice. And before we end, I understand that you have a new book that you're working on.
Yeah, so I was working on it. It's called The Unspeakable Level. So it's
Ah,
about we talk about these abstractions and what they refer to, and Krzyzewski called that sort of swirl of possible things that are out there as the unspeakable level, and that's what it's kind of an extended meditation around that idea, what it means, what it could be, all that sort of stuff. So, yeah, I'm working on that, and we'll see.
well, that sounds great. And I think something to look forward to, uh, be published by the IGS. And,
Yes.
yeah. Well, thank you so much, Chris. This has been, again, enlightening. It hasn't been, I won't say it hasn't been disturbing because, you know, but it's not any more disturbing than what's happening outside of this podcast. And at least it's a little comforting to know that there are folks like you who at least have some sense of what's going on and can at least explain it to the rest of us. And hopefully we'll all just hang on for dear life and make it through to the other side.
Yeah. Well, thank you for having me on. It's great to talk to you about these things. I think it's important. I think it's, like I said at the beginning, I think it's one of those occasions where I really do think the language and our abstractions really loom large in this whole thing and affects how people think about it. And so, yeah, I think it's important to talk about it and bring it out. And even if we don't have the answers, it helps us see a little more clearly what's at stake and what the issues are. So hopefully people will find at least some value in that.
Yeah, and there's no question that these are both great illustrations of the value of general semantics and certainly great motivation for learning more about general semantics. And as some of the old folks used to say, to get it into our nervous systems before we have a nervous breakdown.
Yes.
Well, thank you again, Chris.
All right. Thank you.
You've been listening to our April 2025 episode of Semantic Reactions featuring Chris Mayer. If you like what you've heard, or even if you haven't, please consider becoming a member of the Institute of General Semantics if you're not one already. In addition to supporting our efforts, IGS members receive an annual subscription to our journal, etc., a review of general semantics, access to our online and in-person events, lectures, and seminars, and discounts on the books and audiovisual materials that we sell. Regular membership is only $50 and half off for students. Your membership and any additional donations you care to make will help to support our offerings and activities as we work to bring a measure of sanity to the world. The Institute of General Semantics is a 501c3 nonprofit organization dedicated to research and education on a wide range of topics. They include language and symbols, meaning and perception, communication and representation, media and technology, science and epistemology, creativity and critical thinking. We are dedicated to making the world a better place through practical strategies for improving our semantic environment, individually and collectively. For more information about the Institute and our activities, and to become a member and supporter of our work, please visit our website at generalsemantics.org. That's generalsemantics, one word, .org. And this brings to a close our 32nd episode of Semantic Reactions, the official podcast of the Institute of General Semantics. This is Ben Houck signing off saying, we hope you'll join us next time. And until then, just remember this simple fact, that the map is not the territory. This is the first line.